Hello and welcome to Weekend Investing Daily Bytes. Today is 7th of March. We're shooting episode 189. And nothing seems to be working in the markets right now with the war still on and crude oil almost racing every day. With the markets today found that the oil price is up 10% overnight from Friday close and at $120-$130 per barrel. That will not be taken well by the markets in any case. And on top of that, of course, the FII selling has continued, and there is little in terms of positive sentiment in the market. Also, with March closing coming around, a lot of investment support which usually comes in is expected as people buy for their ELSS, etc. So that's probably is what is keeping the market still sane to some extent, the domestic buying. But if that domestic buying stops, then we've had it actually. So and on the global front, there does not seem to be any de-escalation happening. Either side is not willing to back off. And what was earlier being seen as a few days event seems to be stretching out with no real breakthrough in terms of talks, etc. So in terms of the market was really, it gapped down and stayed down pretty much between 2 and 3% for the day on the Nifty, and closed at minus 2.4%. Within the sectors, real estate was bashed at minus 5.5%, private banks, PSU banks almost 5% each, autos 4%. And very surprisingly, FMCG has not been the defensive sector where money usually rotates to in such situations. FMCG, IT and pharma are the three sectors which are usual beneficiaries whenever there is a risk off and market sell-off. But this time FMCG has also been beaten badly. Margins are getting impacted hugely due to high inflation, and every management in FMCG has come out and talked about the high inflation figures and how it is going to hurt margins going forward. So only pharma and IT were sort of flattish, but metals, of course, along with the commodities, were with a green tick on some stocks. Metals, as you can see, are the best performing sector this year, financial year, up 54%. And private bank has been the worst at minus 6.3%. So the fact that the stalwarts like HDFC Bank, which make up almost 15-17% of Nifty, somewhere like that, are both near or at 52-week lows, that tells you about how badly this sector is performing. So in any case, the selling was pretty much broad-based. Mid caps, small caps, large caps, Nifty Next 50, everything was down between 2 and 3%. What I do want to point out here is that NG 50/50, our free portfolio, which invests both in Nifty and gold in equal proportions, was up 0.4%. For the last month, it is up 1.3%. For the 3-month period ending, it is up 2%. And for the financial year, it is up 15.6%, almost double of what Nifty has performed here. So you can see the magic of the hedge that gold provides in this. And I have been repeating this like a broken record, and I'll keep doing that until this message gets across that you must have a counter hedge in your portfolio. The same has been demonstrated very well in Mi EverGreen, which is a portfolio of 20 CNX 200 stocks and 25% allocation to gold. And you can see even today, on a market like today, when CNX 200 fell 2.4%, this portfolio was up 0.09%. This is really, really heartening that the hedges work, and they work very well. In the last 3 months, this portfolio is down 2% versus minus 8% for CNX 200. And for the financial year, this is up plus 35% versus 9% for CNX 200. So this is really, really, proof of the pudding, so as to say. So if you're looking for long-term conservative portfolio with hedge, Mi EverGreen probably is the best one out there. Mi ATH also was up today. Some stocks in it were flying higher, but then there were other portfolios which did not do so well. Mi ATH2, Mi 25, Mi 35, Mi 20, Mi NNF 10, which got hurt at minus 4%. So we have now come down almost, I think, 15 or 16% on the Nifty. On the Bank Nifty, we have come down even much lower. So as soon as we do hear some de-escalation of news on Ukraine, I think we should cover back some ground. But it's very difficult to pinpoint how the timing will happen, and hence one needs to remain invested and remain continuing your SIPs or invest more strategies that you have been doing. My experience of last 27 years, I think now, at least for myself, I can say I can never time the market to any perfection or consistently. So I have also chosen the path of consistently adding funds to my SIPs, and I find that has done very well for my portfolios, and the same should work for you as well. In terms of the market internals, top gainers, ONGC was up 13%, HEG up 13% again, KSB Pumps, Sheela Foam, Z Entertainment, all these stocks were up nicely, and JK Cement, Brigade, India Mart, Hitachi and Godrej Consumer, they were best down between 8 and 12%. Sugar stocks, as have been seen in the recent past, as all food grade commodities are moving up. Sugar is also moving up. Balram Chini was pretty much in focus. We also added Balram Chini in one of the portfolios this morning. And Awadh Sugar, Dhampur Sugar, all the sugar stocks have been going up, along with wheat and all other food commodities that are out there. And even non-food commodities have been doing extremely well, aluminium, tin, copper, and of course precious metals in gold and silver. So another insight here was that, a lot of people tend to think in binary terms, so 0 or 1. So either we'll go flat down or we'll go all the way up, but market doesn't work like that. It need not swing between very bad and very good. There is good middle ground also, and we've had some decent years in 2020 and 2021 calendar years. So some bit of a rest period for the market, where some of those gains are being given up, is also par for the course. So do not panic, and this is the nature of the market to do this sort of a pendulum run. Now FIIs have been selling almost on a daily basis, and last many days the sales have been upwards of 5,000 crores on each leg. There was some news that because Russia stocks have been taken out of the MSCI Emerging Market Index, so there will be $500-600 million of inflows into Indian stocks. But with the kind of outflow that is happening, that is maybe like one day's worth of outflow. So I don't know if that makes much of a difference. But as a insight, this is not the first time that FIIs are selling in the Indian markets. We have seen this is in 2008, a huge sellout, then 2013-14, then 2015-16, then 2018 NBFC crisis, 2020 of course COVID crisis. So several times there have been huge bouts of FII selling, but market has still done well over all these years of year and a half, decade and a half, and the domestic demand is meeting the supply very well this time. So not too much worried about just the FII part of it. Bank Nifty, as I said, is much weaker than Nifty in terms of its price movement. You can see here that this was the pre-pandemic area around 32,000, and we went down to about 16,000, almost halved from here, and from 16 it went to nearly 41,000, and we have returned to near 32,000. So the entire sort of net pandemic gain has been given up by Bank Nifty, and which is not a very good sign, because I believe Bank Nifty is sort of a leading indicator of the economy. Whenever the economy is doing well, the banks are running ahead of the rest of the stocks. So Bank Nifty being down back to pre-pandemic levels for me is not a very good sign, but you never know. It's a very volatile animal, and once things do cool off at the war front, I'm hoping that some of the lost ground will be made up. Another insight that we shared this morning was the Nikkei story. A lot of Nikkei index stories are always there, that the index has not come back even after 24 years. So this peak was made somewhere in 1991, and the Nikkei index, which is the Japanese index, has not returned back to this point. So whoever bought in the top 10-20% of this index has never seen those values again. So yes, I mean the fact of the matter is that that's a true story, but it is also true that the index went up almost somewhere close to I think it was 8 or 9x in this decade, going from 1979 to 1989, and that is a pretty unimaginable sort of a run within a decade. Imagine Nifty going from 15,000 to 1,30,000 in the next decade. So that's a pretty hefty run, and once that excesses were taken off, it has been more of somewhat in the range. And then of course we had the crisis, the great financial crisis. So anybody who would have come in with lump sum amounts in this huge euphoric run would have lost out dramatically. Anybody would have come in lump sum amounts in the run before this would have made humongously. Even if you had got in here and held through all this, you would have still made a CAGR of 6%, which in a zero rate environment in Japan is still not so bad. But if you had come in with SIPs, you probably are not in a very bad situation. I would say it is nowhere near the gains you would have made in international markets. But assuming that you would have had a strategy of rotation out of bad stocks and good stocks into the index, something like NNF10 does or some other strategies do, you would still not be in a bad situation. So don't assume that this Nikkei story, this horror story that a lot of people are always broadcasting, especially in bad days when Nifty is getting hammered. There is no such fear on the Indian market as such. India is a growing market. Even if we are at higher value, and on the valuation front also, although I'm not much of a valuation follower, but I'm told that the forward earnings on the Nifty has now reduced to under 20, and in the last decade or so, under 20 forward 20 earnings has not been price earnings has not been a bad place to be at. So from that perspective, a lot of the froth is gone, because we had reached almost forward earnings of I think 36 or 38. So from that perspective, a lot of froth is gone, and if the economy continues to perform at 6, 7, 8%, we will catch up very soon with earnings looking very cheap. So from that perspective also, I am not very pessimistic about the market as such. So these were all the thoughts for the day, and I hope you keep watching the daily bites, and I'll see you in another video. Bye.